Okay, as we dive in, we will make it short and simple, thus assuming zero knowledge, so we can achieve the objectives of this series. You will agree with me, like I said earlier, that the target audience includes non-accountants. I believe that so many persons who are investors, and as a matter of fact, that sit on the board of some organizations, might find it very difficult to understand the numbers presented on the financial reports, the financial reports segment of the usual annual reports. I believe this introductory session will deal with it, will demystify these numbers for them. Now, like I said earlier, it is very important to set the tone and the background of this discussion so that we'll get full benefit. Now, as a starting point, we need to understand what financial reporting is all about. Um, Basically, financial reporting is the actual presentation of the financial results of an organization, which is usually released at its stakeholders meeting or annual general meeting, or presented to the owners of the company. This report typically involves the issuance of what's called financial statements. Usually, you see companies prepare annual reports. In the annual report, you see different sections. And of course, one important section in annual report is the company's financial reports, which contains the financial statements. Investopedia will tell you that financial statements are written records that convey the business activities of a company or the financial performance of a company. Now, usually, financial statement contains several, subset statements in them, namely the balance sheet, which is also known as the statement of financial position. We have the income statement, which is also known of as statement of profit or loss, statement of cash flows, statement of changes in equity, and then explanatory notes to the accounts. These we are going to see in a short while, but I'll explain it briefly. So while we're looking at this, let's start with what they call or what is called the balance sheet. It actually shows the aggregate, in aggregate, the organization's assets, liabilities, and the shareholders' equity. Okay, and usually prepared, at a specific period in time. You say the balance sheet of a company as at 30th of June 2022. The date is usually the last day, okay, of the reporting period range, which is used in the income statement. I'm going to explain this later. While the second one, called is the income statement, or it is the statement that presents a summarization of the company's sales, expenses, and profits for the period, usually for a specific period of time. Okay, what we usually would call profit and loss account or profit or loss account, which basically shows for the period under review how much the company has made in terms of profit. The period can be a month, it can be a quarter, it can be 6 months, or it can be 1 year. Of course, most organizations present annual financial statements, which shows 12 calendar months. Now, the next statement there is the statement of cash flows. The statement of cash flows usually present an aggregate view of the company's cash flow, that are associated with operation, financing, investing activities. Well, this is a usual report for examining how cash is used within the business. Note that it can actually be a better view of the viability of a business than the income statement. Okay, that is why most times companies or businesses are looking for facilities from lenders, banks, beyond getting other information from the company. The bank or the lender will usually ask for statement of cash flows so that they understand, the pattern of the company's cash flows. Now, the another one is what is called statement of changes in equity. Now, this statement it shows basically the movement or reconciliation of the shareholders' equity, between two balance sheet periods. This, for many, is the missing link between the income statement and the balance sheet as it reconciles the opening balance of the equity account, in the balance sheet with their closing balances. Well, the purpose of a statement of changes in equity is to furnish the shareholders with information that can further inform them of their investment strategy. It can be used most times to identify the par value of the company's ordinary shares. Now, the last one, which is also very, very important, is what we call explanatory notes. Sometimes you see it's written as explanatory notes and significant accounting policies. There is usually a section of the notes, that accompany the company's financial statement, which usually describe the key policies which are followed by the accountant, in preparing the financial statement that are so presented. Well, policies are rules and guidelines that are selected by the company, for use in preparing and presenting a financial statement. Now, having gone through this, well, since this is all about both accounting standards or reporting standards and auditing standards, let's just give a brief intro about audit. Well, basically, audit is basically a review of companies' financial statement, over a period of time. Now, the audit we are referring to here is basically the statutory one, because there are different types of audits. There are audits that are required by law, okay, statutory audits, which of course is done on an annual basis. Usually, it is usually legally required. It's a legally required review of the accuracy of the company's financial statements or assertions that are made by the management of the company during a period. Okay, now having seen the makeup of your normal financial statement, it's important to note here that there are policies and guidelines, that apply in preparing and presenting these financial statements. Okay, financial statements are actually expected to conform with generally accepted accounting standards. We know that these standards can be viewed as a benchmark for measuring performance. Therefore, within the context of our discussion, financial reports must conform, with the extant reporting standards, or whichever is a reporting standard that's existing or approved at that point in time. In a similar manner, in performing statutory audits, certain authoritative or definitive guidelines must be followed. Hence, the auditing standards and the extant standards at the moment is the international standards on auditing. At this point, it is important to look at examples of contents of financial statement in line with what we had explained in earlier slides. Now, as you can see on the slide now, we have IFRS, which is the current reporting standards that, of course, which has been adopted by so many countries all over the world, including our Nigeria. Then, of course, international standards on auditing and assurance, what we call ISAs, has also been adopted by Nigeria and so many other countries in the world. So those are the standards that are conformed with in carrying out audits. Now, what we have on the slide now is your typical, it actually explains what the balance sheet is. If you look at the left side, tells you what the company owns, while the right side tells you what the company owes. What the company owns, that's what belongs to the company, and then what the company is using that belongs to others. These two sides must be equal. Now, why is it very critical or important to explain this? So that whenever you're looking at a balance sheet or statement of financial position, you can actually appreciate what you're looking at. Now, on the left side, you have all company assets. That is what the company owns. These are the things that belong to the company. And these assets are actually financed by the long-term debts. They are financed by monies that are borrowed. They are financed by the owner's equity, which in this case is the owner's share capital, paid-up capital, and their retained earnings. Simply put, these are the profits that they have plowed back into the business over time. So this brings us to what we usually call the accounting equation. Your assets must be equal to your liabilities and your equity. Okay, and that's the balance sheet. Then what we have here is a prototype income statement. Yeah, which, like we said, what the income statement shows is basically a summarization of company sales, expenses, and profits. The bottom line of an income statement is to know what the net profit for the period is. Like I said, income statement is over a period of time. It could be 1 year, it could be 6 months. With what you have here, you have the sales, you have the cost of sales, you have other costs, you have the expenses, and of course, you have income before taxes. And then you apply the tax for the year, and you have net income. Now, this net income, of course, depending on whether the company has decided to, pay dividend or not, this net income finds its way into the company's equity. If it's plowed back into the business, it will find its way on the left side, the right side of the balance sheet, this area that is colored green, it will find its way as part of the retained earnings. You can now see the link. However, it doesn't just go there. It passes through that link, which is called statement of changes in equity. So on the right side here, you can actually see it's another equation there. When you have your sales and revenue minus your cost and expenses, gives you your profit before taxes. Now, another important statement, like I said, that is very, very critical, which I say can actually give you a better view of the business viability, because it shows the pattern of your cash flows, how your cash for the business is generated, using the business is generated, and how it is being expensed. Simply put, like I said, this statement tells you how much cash is entering or leaving your business in a given period. It provides aggregate data regarding all cash inflows of the company that the company received from its ongoing operations. Now, the statement of cash flow is usually broken down into three major sections. You have the operating activities. These are the key activities of the company. What is your business into? Okay, what are the what level of cash or quantum of cash did you generate and spend in the course of your normal business operations? Okay, that gives you what you have at the bottom line there, which is labeled A. Okay, and then we also have the other section called investing activities. Of course, in the course of business, you need to acquire assets that are used, critical assets that are used to generate a profit for the company. And of course, over the period, you might also need to sell assets and replace them. So this section also shows the cash flow that is generated under investing activities. Remember, investing activities are not within your normal business operations. Okay, and then when we look at the next one is the financing activities. Of course, in the course of business, if you remember the slide on the balance sheet, we have two sides. Okay, on the right side, we have what the company is owing. Yes, money that is borrowed from banks, and then we have the equity. Equity simply means the money that's basically it's what the company is owing as shareholders. Shareholders are the owners of the company. So whatever money is brought in and taken out in that section of the balance sheet is reported here. For example, you see issuing of new shares. If there was any additional shares issued, whatever inflow that came in from that reports here. Okay, and the money that's borrowed from the bank, in this instance 26,000 naira was borrowed from the bank, and then of course the company paid dividend, financing, and then you have to repay some loans, financing. At the end of the day, you have a net cash flow from financing activity. So at the end of the day, when you aggregate all these cash flows, net cash flow from operation, from investing, and from financing, you have what we call the net increase or decrease in cash during the period. So now, of course, at the beginning of the period, the period could be the beginning of the year, the first day of January 2021 or 2022, depending on the year you're reporting. Peradventure, you had okay, in this instance, at the beginning of the year, the company had 10,882 naira, and then after operations for that particular period, there's a net increase, okay, coming mostly from financing activities, and then the net there is 11,260, and then the final balance there, which of course we show on your balance sheet, is 22,142 naira. Of course, then the other statement that we talked about is the statement of changes in equity. Now, we say this statement, okay, is the link between the income statement and the balance sheet. Now, it also shows, like we said, it reconciles the equity balance, okay, from between the beginning of the reporting period, and the end of the reporting period. If you look at this, you see balance at the beginning of the year, the company share capital was 200,000. There was no additional share issued, so it still remained 200,000. The retained earnings at the beginning of the year was 43,000, and the profit for the year is 13,716. Okay, as generated from the income statement that we saw earlier. And then when that has to be, since no dividend was paid, the company didn't pay dividend from this year's profit. So this is plowed back into the business, swelling the company's retained earnings from 43,000 to 56,000, roughly 60,000. So this statement basically explains changes in the company's share capital, accumulated reserve, and retained earnings for the period. Now, if we look at what we've seen so far, you can see that it's important that we build this background so that we can actually progress. Thank you for listening.